Stop! Are you over 65? The IRS just changed the rules, and it could cost you thousands. Listen closely because what you don't know about the one big beautiful bill could be the difference between a comfortable retirement and a massive, unexpected tax bill. Most seniors are completely unaware that the IRS has just unleashed a series of hidden rules for 2026 that are fundamentally changing how you withdraw your money and claim your deductions. Here is the high-stakes reality. If you are 73 or older, missing the new required minimum distribution (RMD) deadlines isn't just a minor slip-up, it's a financial catastrophe. We are talking about a 25% excise tax penalty on every dollar you forget to withdraw. But wait, there is a silver lining that 90% of retirees are missing. A brand new $6,000 bonus deduction, or $12,000 for couples, is now live, and it stacks on top of your standard deduction. If you don't claim it correctly on the new Schedule 1A, you are essentially handing your hard-earned savings back to the government. In this video, I'm breaking down the Two-RMD Tax Trap, the new Super Catch-Up rules for those still working, and exactly how to shield your Social Security from these aggressive new brackets. This is the ultimate survival guide for your 2026 taxes. Don't let the IRS take a bigger cut of your legacy. If you want more updates that protect your wallet, hit that like button right now, and let's dive into the details. Now that you understand the gravity of these RMD penalties and that massive hidden bonus deduction, we have to talk about the absolute minefield that the IRS has laid out for the 2026 tax season. This isn't just about filling out a different line on a form. It is a fundamental shift in how the government views your retirement assets. And if you are sitting on a 401k or a traditional IRA, you are essentially standing in the crosshairs of a major legislative pivot. You have spent decades diligently saving every penny, passing up on vacations or new cars to ensure your golden years were secure, only to find out that the goalposts have been moved right as you're stepping up to kick. The Two-RMD Tax Trap is the most sinister part of this entire update because it targets the very people who tried to be the most responsible with their money. If you turned 73 recently, the IRS has created a specific overlap period where you might be required to take two massive distributions in a single calendar year, which can instantly catapult your taxable income into a bracket you haven't seen since your peak earning years. This isn't just about paying more tax, it is about the clipping effect where that spike in income triggers higher Medicare Part B premiums and causes more of your Social Security benefits to become taxable. It is a domino effect of financial drain that starts with one simple oversight, and that is why we are going to spend the next 20 minutes ensuring you have an airtight shield around your wealth. The reality of the current economic climate in 2026 is that the federal government is looking for ways to recoup revenue, and the massive trillions of dollars sitting in deferred retirement accounts are the easiest target. For years, the rule of thumb was to delay taking money out as long as possible to let it grow tax-free, but that strategy has officially become a double-edged sword. When you look at the new Section 603 regulations, the IRS has effectively eliminated the grace period for many first-time RMD takers. In the past, you could delay that first distribution until April of the following year, but doing so now creates a tax bomb, where you are forced to take your 2025 and 2026 distributions in the same 12-month window. Imagine adding $60,000 or $80,000 of artificial income to your tax return in one shot. It doesn't just increase your tax bill. It can actually disqualify you from certain low-income credits and senior property tax freezes that many states offer. You have to be proactive, and that means looking at your total portfolio not as a single pile of cash, but as a strategic sequence of withdrawals that must be timed with surgical precision to avoid the 25% penalty, which, let's be honest, is an absolute gut punch to anyone living on a fixed income. Let's move deeper into the super catch-up provisions that are catching even the most seasoned financial planners off guard this year. If you are 55 or older and still working, the government has given you a massive opportunity, but it comes with a very specific trapdoor that could lead to an immediate audit if handled incorrectly. The new 2026 limits allow for an unprecedented surge in contributions, But the IRS is now requiring that these catch-up amounts be funneled into Roth accounts for anyone earning over a certain threshold. This is a massive departure from the choose-your-own-adventure style of retirement saving we've had for 40 years. They want their tax money now rather than later. And if you accidentally contribute these funds to a traditional pre-tax bucket, the penalties for excess contributions can compound year after year until they've eaten a hole right through your principal. It's incredibly frustrating because these rules are buried in hundreds of pages of technical jargon that the average person has no time to read, yet the burden of compliance falls entirely on your shoulders. You are essentially being asked to be your own high-level tax attorney, while also trying to enjoy the retirement you earned. While we are on the subject of Roth accounts, we have to address the hidden window for Roth conversions that is closing faster than most people realize. Because of the way the 2026 tax brackets have been adjusted for inflation, there is a very narrow sweet spot in the middle income range where you can move money from a traditional IRA to a Roth IRA for a lower tax rate than we are likely to see for the rest of the decade. This is what I call the legacy guard strategy. By paying a little bit of tax now at a controlled rate, you effectively prepay the IRS and ensure that every single penny of growth from here on out, and every penny your heirs eventually inherit, is 100% tax-free. If you wait until the IRS forces you to take RMDs, you lose all control over the tax rate you pay. You become a passenger in a car the IRS is driving. But by taking control of the conversion process now, you take back the steering wheel. It is about moving from a position of tax defensive to tax offensive. You want to be the one deciding when the government gets their cut, not the other way around. Now, I want to talk about something that hits home for a lot of seniors, and that is the Social Security siphon. This is a phenomenon where the IRS uses your RMDs and your investment income to effectively tax back your Social Security benefits. Most people believe that Social Security is tax-exempt, but under the new 2026 thresholds, even a modest retirement income can trigger the 85% rule, where 85 cents of every dollar you receive from the Social Security Administration is considered taxable income. This is why the one big beautiful bill I mentioned earlier is so vital. By utilizing the new 2026 senior bonus deduction correctly, you can effectively lower your provisional income. That's the specific number the IRS uses to determine if your Social Security is taxed. If you can keep that number just $1 under the threshold, you could save yourself $3,000 to $5,000 a year in taxes. That is money that stays in your pocket for travel, for your grandkids, or for your own healthcare needs, rather than vanishing into the federal treasury. We also have to discuss the Qualified Charitable Distribution, or QCD, which has been massively expanded under the new rules. This is perhaps the most powerful tool in the senior tax arsenal that almost nobody is talking about on the evening news. If you are over 70 and a half, you can now transfer up to $105,000 directly from your IRA to a qualified charity without that money ever showing up as income on your tax return. This is a game changer because it satisfies your RMD requirement without increasing your adjusted gross income. Why does that matter? Because your adjusted gross income is the master key that unlocks almost every other cost in your life, from your Medicare premiums to your eligibility for certain tax credits. By using a QCD, you are essentially making a donation using pre-tax dollars, which is far more efficient than taking the money out, paying tax on it, and then writing a check to your church or favorite nonprofit. It is a way to do good in the world while also telling the IRS that they don't get a piece of your generosity. But here is where things get truly urgent. The IRS has updated their automated matching systems for 2026. They are now using advanced artificial intelligence to scan Form 1099-R distributions against your reported income in real time. In the past, you might have had months or even years to correct a mistake before a human auditor noticed. Now the system is designed to trigger an immediate notice of deficiency the moment a discrepancy is flagged. This means you have zero margin for error. If your brokerage firm reports an RMD that doesn't perfectly align with what you put on your Form 1040, you'll receive an automated bill with interest already tacked on. It feels cold, and it feels aggressive, because it is. The government is leaning on technology to squeeze every possible cent out of the system, which is why your record keeping this year needs to be more meticulous than it has ever been in your entire life. You need to be tracking every single transaction, every wash sale in your brokerage account, and every penny of tax-exempt interest, because the robots are watching. One of the biggest mistakes I see seniors making right now is assuming their tax preparer or their big box software program will catch these nuances. The problem is that most software is built for the average taxpayer, not for someone with the complex needs of a senior with multiple income streams. You cannot rely on a computer program to understand the specific look-back provisions of the new 2026 laws. You have to be the primary advocate for your own wealth. You need to be asking your CPA very specific questions about the high-income senior phase-outs and whether or not you are eligible for the itemized bridge that was recently introduced for medical expenses. If your preparer isn't talking to you about the 7.5% floor for medical deductions and how it interacts with your RMDs, you might be leaving a fortune on the table. In 2026, medical costs are skyrocketing, and the IRS has actually made it slightly easier to deduct these costs, but only if you know exactly how to categorize them. Let's talk about the inherited IRA trap, which has become a nightmare for many families over the last few months. If you have inherited an account recently, or if you are planning to leave one to your children, the 10-year rule has been radically reinterpreted by the IRS. It used to be that your heirs could wait until the 10th year to take all the money out. Not anymore. Under the latest 2026 guidance, many heirs are now required to take annual distributions throughout that 10-year period. If they miss even 1 year, they are hit with that same 25% penalty. This can be a massive burden for your children who might be in their own peak earning years, suddenly forced to take a taxable distribution that pushes them into a 37% tax bracket. This is why multi-generational tax planning is no longer just for the ultra-wealthy. It is a necessity for the American middle class. You need to have the tax talk with your kids now, ensuring they understand the liability they are inheriting and exploring options like life insurance trusts or stretch Roth strategies while you still have the time to implement them. As we move toward the end of the first half of 2026, the window for tax loss harvesting is also shifting. With the market volatility we've seen, you might have some losers in your portfolio. In the past, you could only use $3,000 of capital losses to offset your ordinary income. There is a massive push in Congress right now to adjust this for inflation, but until that happens, you have to be very strategic about pairing your losses with your gains. If you are forced to take a large RMD that is already pushing you into a high bracket, selling a stagnant stock at a loss can be a powerful way to neutralize some of that phantom income. But you have to watch out for the wash sale rule, which prevents you from buying that same stock back within 30 days. The IRS is checking those dates with extreme scrutiny this year, looking for any excuse to disallow your loss and keep your tax bill high. The common thread in all of these updates is a move toward complexity and away from transparency. The IRS isn't going to send you a friendly letter explaining how to save money. They are going to send you a complicated form and hope you don't notice the deductions you're entitled to. That is why staying informed is your only real defense. We are entering an era where financial literacy is the most valuable asset you own. More valuable than your house, more valuable than your car, and in some cases, more valuable than the cash in your bank account. Because if you have $1 million but you lose 40% of it to preventable taxes and penalties, you really only have $600,000. The theft of inflation is bad enough, but the theft of unnecessary taxation is something you actually have the power to stop. It is also worth mentioning the state-level shift. While we focus a lot on the federal IRS rules, many states are quietly decoupling their tax codes from the federal system in 2026. This means that while you might get a bonus deduction on your federal return, your state might not recognize it, or they might have their own separate RMD penalties. If you live in a state like New York, California, or Illinois, the interaction between federal and state tax laws has become a labyrinth. You could be doing everything right for the IRS while simultaneously triggering an audit from your state's Department of Revenue. It's an exhausting game of whack-a-mole, but it's a game you have to play if you want to keep what is yours. I want you to take a deep breath and realize that while this sounds overwhelming, you are already ahead of the curve just by being here and learning this. Most people will wait until April of next year to even think about these things, and by then, it will be too late. The tax year doesn't end in April. For the smart investor, it starts in January and ends on December 31st. Every decision you make between now and then, every check you write, every stock you sell, and every withdrawal you make is a brick in the wall that protects your retirement. You have worked too hard for too many years to let a new rule or a hidden penalty take away your peace of mind. We are going to keep monitoring these IRS updates as they roll out because 2026 is shaping up to be one of the most volatile tax years in American history. There are even whispers of further emergency adjustments to the standard deduction depending on how the mid-year economic reports look. You need a source you can trust to cut through the noise and give you the bottom-line facts without the political spin or the confusing legalese. That is my commitment to you. We are going to navigate this together, one step at a time, ensuring that your golden years are actually golden and not just a source of green for the government. The new rule most seniors don't know about is actually a collection of these shifting plates. It's the RMD age change, the Super Catch-Up Roth requirement, the Social Security Provisional Income Trap, and the AI-driven audit system all merging into a perfect storm. But a storm is only dangerous if you're caught outside without an umbrella. By watching this, you've just built yourself a shelter. We are going to continue exploring the senior tax shield in our upcoming segments, looking at how to protect your home equity from new unrealized gain proposals, and how to ensure your Medicare premiums don't double overnight because of a one-time capital gain. Remember, the IRS is counting on your silence and your confusion. They thrive when people just pay the bill because they're too tired to fight it. But you're not that person. You're informed, you're alert, and you're ready to take action. This is about more than just money. It's about the freedom that money provides. It's about the ability to say no to things you don't want to do and yes to the things that matter most. It's about leaving a legacy for your family that isn't gutted by the taxman. So, as we prepare for the next round of updates, keep your records organized, keep your eye on your RMD deadlines, and most importantly, keep questioning everything the government tells you about your fair share. Your fair share is exactly what the law says it is, not a penny more. In the coming weeks, I'll be releasing a deep dive on the 3-year look-back for gift taxes, which is another area where the IRS has quietly tightened the screws. If you're planning on gifting money to your children or grandchildren to reduce your estate, you need to see that video before you sign a single check. There are new reporting requirements for 2026 that can trigger gift tax returns even if you haven't exceeded the lifetime limit. It's just another example of how the landscape is shifting beneath our feet. But don't worry, I'm staying on top of it so you don't have to. We are going to make sure 2026 is the year you finally master your taxes instead of your taxes mastering you. Thank you for staying through this entire breakdown. Your financial future is worth the time it takes to understand these complex rules. If you found this helpful, it really helps the channel when you share this with a friend or a family member who might be in the same boat. We're building a community of proactive, informed seniors who refuse to be a tax target. Stay tuned, stay vigilant, and I will see you in the next deep dive where we'll uncover even more ways to keep the IRS out of your pockets.